Are we on? Yeah, we're on. Did you like that close up? Okay, so now we're moving into the next section of the investments class where we're going to talk about picking individual stocks. Okay, and I imagine when you guys signed up, most of you probably thought that's what the focus of the course would be on, and yes, this next section will emphasize how to pick individual stocks, the things to look for. But as I've said many times so far this semester, that understanding your client in terms of risk and return and building a proper portfolio that reflects their risk and return profile is your first and foremost job. So with that being said, let's get into top-down investing. Top-down investing. Okay. So to estimate the intrinsic value of a security, and that's what we're trying to do. What is a security really worth? We need to know what a security is really worth so that we can then determine at what price it's a buy and at what price it's a sell. If you don't have an intrinsic value in mind, then you're just shooting in the dark, and we don't want to do that. You need to know at what price to buy a stock and at what price to sell a stock. Let me check this thing because I'm not seeing myself. Yeah, there I am. I'm in there. Okay. So to estimate the intrinsic value of a security, one must apply one of the great maxims or sayings of finance. The value of any asset is the present value, what we should pay today, of the expected future cash flow stream generated by the asset. Why do we buy an asset, something of value? We buy it because we want a return. What should we pay for it? We should pay the expected value of the present value of expected future cash flows. So we're going to forecast out those cash flows, and then we're going to discount those cash flows using either a discount rate or a multiple to determine what we should pay for those assets. Okay. Therefore, cash flows and the discount rate are critical when it comes to valuing businesses and securities. We need to be able to accurately forecast cash flows and an appropriate discount rate to value businesses that we might be interested in buying or investing in, and stocks and bonds. Okay, so cash flows are affected by the general economy. Okay, how is the economy doing? That is going to impact how your business is doing. Okay, by the competition, what does your industry look like? That will affect the cash flows generated by your business. And by company management. What's their track record? How have they done in the past? How are they likely to do in the future? Okay, so to determine the intrinsic value of a security, what it's really worth, okay, you must analyze each of these three areas: the economy, the competition, and company management. Hence the three-step top-down valuation process. So that's what we're looking at. The three-step top-down process, looking at the economy, the industry, and company management. All right, please note that some investors use the bottom-up approach to select stocks as opposed to the top-down method. This strategy focuses on individual companies. So instead of starting with the economy, you start looking at individual companies. Investors will run quantitative screens on a database to identify companies and stocks that meet specified criteria. And this criteria, the things you look at, the things you screen on, is financial data like sales. Maybe you want to see companies that have sales that are greater than a certain amount but less than a certain amount, maybe kind of mid-cap type stocks. We've looked at that, the micro cap, the small cap, the mid-cap, the large cap, and the giant cap. We've looked at that in the index section. And so we might be looking for a certain area in terms of sales. Maybe we're looking at profit margins that are low but are improving, things like that. Maybe we want some leverage but not too much leverage. So we can input data on companies' operating performance. We can also screen based on stock information. So we've got company information and we have stock information, such as valuation. Maybe we want something that has a PE between 10 and 16, not lower than 10, not higher than 16, something like that. And maybe stock prices, so we can screen for operating data, valuation data, stock prices. Maybe we look at stocks that have been doing really well, and maybe we think they'll continue to do well, so we look at stocks that are near their 52-week high. Maybe we're contrarian investors and we look at stocks that are near their 52-week low. Okay, so it depends on what we put in. What are we looking for? What is our style? What are we comfortable with? What are our trading rules? What do we think will generate an attractive rate of return? All right, so this approach can work, this bottom-up approach can work, but it ignores economic and industry influences. And the economy and the industry definitely influence the operating performance and the returns generated by stocks. So we shouldn't ignore the economic and industry influences. There are also some problems with quantitative screening. Okay? For example, almost all companies experience non-recurring events that affect their financial statements. One-time write-offs or blips may be an acquisition that really changes the financial statements. So these things include things like write-offs. These events and or accounting distortions can mistakenly include or exclude companies in the screening process. There may be one-time events that will either cause companies or stocks to be included when they really shouldn't be, or excluded when they really shouldn't be excluded. Most people incorporate elements of both approaches, top-down and bottom-up, as they search for investment opportunities. Okay, let's see how far we get in here. So we're going through slide 7, excuse me. All right, so what are the implications for global investing and for asset allocation if you do top-down investing? Okay, as you decide how to spread your money across different countries and into different classes of securities in these countries, stocks, bonds, commodities, in different countries, different systems, okay, you should begin the process by evaluating the economies of these countries. Generally, you should invest less in countries that have been experiencing high economic growth for an extended period of time. For example, the United States. We've been growing at a good rate since the financial crisis 2009, okay? That means we are getting closer to the end of the cycle than we were at 9 years ago at the beginning of the cycle. That means if you have a range of asset allocation to be invested in the United States, let's say that range is 50 to 60%. I would argue that since we've been growing for 10 years, that you should be closer to the 50% side of that range rather than the 60% side of that range. Okay? Economies in the late stage of the business cycle often start experiencing higher inflation. What's happening with our inflation rate? It's been moving higher. It's not really high, it's still around 2.5%, but it's higher than it was a couple of years ago where it was less than 1%. Okay? Central banks typically try to neutralize inflation by raising interest rates to slow the economy. Okay? Slowing economic growth and rising interest rates are generally negatives for stock returns. Okay? Alternatively, so while you're avoiding countries that are at the tail end of their expansion, you might consider investing more in countries that have been in recessions for a while and look like they are beginning to experience better economic times. Maybe the government has stepped in and they are cutting taxes and they are raising spending and their central banks are injecting money into the system. They're trying to revive these economies. That's a good time to be at the higher end of the investment range. Okay? This process of adjusting your portfolio is called underweighting and overweighting, and we've talked about that before. Okay, we're going to stop there, and we'll move on to slide 8, clip 2, slide 8 in just a minute. Shalom. Peace.